This could change everything for the markets. Next week, the Federal Reserve is set to meet. A bunch of men are going to decide what's happening with your money. It's widely expected that the Federal Reserve will be slowing down the size of their interest rate hikes. For months now, the Federal Reserve has been making some very aggressive moves with rate hikes of 0.5% or 50 basis points per month. Currently, those rates are sitting at 4.25%. Most people expect that the Federal Reserve will only raise rates by 0.25% or 25 basis points next week, bringing the rate up to 4.5%. Now, this would indicate a significant shift overall in the aggressiveness of rate hike policies by the Federal Reserve, and that the Federal Reserve is, in their opinion, on the right track to tackling inflation, and that rates could even stop hiking pretty soon. The Fed has stated a target of 5.1%, which could indicate 2 more 0.25% rate hikes in February and March, and then a 0.1% rate hike in April. Meaning that if this 5.1% estimate holds true, then April will be the last month of rate hikes. Assuming, of course, that inflation does continue to fall, that becomes a pretty likely scenario. All cards off the table if inflation spikes back up, obviously. The numbers for inflation for December showed that inflation is still indeed falling, though it's down to just 6.5%, which is down from 7.1% in November and down from 9.1% in June. Now, this would seem to indicate that the Federal Reserve is currently winning the war on inflation for now. But the inflation target of the Fed, 2 to 3%. So we still have a long way to fall inflation-wise to reach that. So if we do hit a terminal interest rate hike of 5.1% in April, what does that mean for the markets? Well, I'm going to tell you about that in just a moment, but in case you're not yet signed up for the Wealth Mastery newsletter, then now's the best time. What are you waiting for? We talk about altcoins, DeFi, NFTs, airdrops, and much, much more every single week straight to your inbox. Find out why over 50,000 weekly readers love our newsletter and sign up for free using the link down below in the description. Okay, so what will happen when rate hikes stop? The short answer is nobody really knows, but speculation is that we could get a boom period between now and later this year when rate cuts inevitably start again, right? We start seeing them go back down. Markets love certainty, and rates kind of being flat would be not a bad situation. A terminal rate of 5.1% will give markets the needed narrative to grasp onto. The rate hikes have stopped. Let's rally. And yeah, a market can have a rally in a high rate environment. From 1995 to 2000, rates were consistently around or over 5%, and the dot-com boom happened. During that time, we saw the S&P 500 go up 250%. We saw the NASDAQ go up 1,000% during that time of high interest rates. It kind of feels like the whole Fed pivot narrative could already be in effect here too, based on the anticipation of a 0.25% rate hike to be announced next week. Then we come into the potential for the rate cuts later this year or early next year, a wild card that could help or hurt markets, making a 2023 situation potential 2019 repeat. Rally early in the year followed by a crash later in the year. That's what happened to Bitcoin. Stocks rallied actually. But currently the Fed is predicted to bring rates down to 4.1% in 2024 and 3.1% in 2023. But all this largely depends on how much damage the rate hikes have actually done. And make no mistake, the intent of the rate hikes is to do damage. They want you to lose your job. They want your wages to go down. They want the price of your house to fall, maybe for you to lose your house. They want consumer demand to fall so businesses go broke and have to fire their employees. They want everyone broke. The Fed is trying to bring things back to normal by kind of screwing millions and millions of people. But history shows that rate cuts can happen very, very fast, especially in the face of crisis, which is why often many people correlate rate cuts with steep stock market declines. A recession could be such an event that would kick all that off, right? Ironically, that recession, if it happens, will be caused by the rate hikes. Still though, markets are apparently pricing in the best case scenario, a potential return to normal on inflation in the coming months and a potential soft landing for the economy, maybe, right? But if a recession is still coming, then understand that the S&P 500 has never bottomed before the start of a recession, which means we'd have lower to over stocks. It always bottoms in the recession, and of course where the S&P 500 goes, so does Bitcoin and crypto. And while many expect rate cuts to lead to the crash of crashes, It is not always the case that when we have rate cuts, the markets crash. Again, they do correlate often due to prevailing economic conditions, but look at 2019. We saw rate cuts start in August, and they went pretty normally until February, when we had a dramatic drop from 1% down to 0%. And what did stocks do in that time? Well, they went up. They went up the whole time until February. The only reason they crashed in March of 2020 was because the COVID thing, man. Otherwise, markets probably would have kept moving in the same direction they had been in spite of the rate cuts. So if rate cuts happen in a terrible recession, yeah, stocks are probably gonna go down and crypto's gonna go right along with it. If rate cuts happen during a very shallow recession, or if no recession happens at all, something that is still a possibility, then markets could continue higher. And if we don't get any rate cuts this year, then the market can still also pump, as it's just gonna be riding high and that we don't have rate cuts yet, keep pumping the market. We can find historical precedent for all of those kind of narratives. But regardless of what actually happens, one thing is for sure, that everyone is definitely going to be watching and waiting to see what Jerome Powell says at the Federal Reserve meeting next week. Okay, that's it. Subscribe now. See you next time.